When you talked about U.S. Treasuries, for example, arguably the safest investment that there is, Treasuries are actually a good option because they are liquid. They are easily sold. You can turn them into the cash and then generate what you need very, very rapidly. And the last one I looked at, which was earlier this week, you're typically in the low 4% range. So you're staying ahead of where current inflation is. Not by much. It's not a sexy investment by any stretch, but your money's not sitting there getting a half or 1% in a savings account. And you can get to it very, very rapidly.
So if you have an excessive amount of cash that you're holding on as kind of a safety blanket, that is actually detrimental to the long-term performance of your portfolio, and we need to make sure we're doing something with that. But if you need additional funds quickly, it's interesting because once you become 59 and a half, you don't need an emergency fund for the purposes of avoiding dipping into your retirement accounts, because everything, in essence, becomes an emergency fund. You have access to your entire portfolio, retirement accounts, cash, taxable accounts, whatever. Everything becomes available to you at 59 and a half, and you don't have to pay that 10% penalty. Welcome back to the Retirement Planning Happy Hour. So we've got a few things on the agenda today. First and foremost, we're going to spend a lot of time talking about cash and emergency funds and how useful and how they should be fit into a retirement plan. But a couple of things first we wanted to talk about before we hop into that. First and foremost, we want to recognize today's
on the day we record this is June 6th. So it is D-Day, and we thought it would be appropriate to have a toast to all the men who made the ultimate sacrifice on that day. So, salute.
Salute. And what are we toasting with?
We are toasting with something kind of special today. This is Rock Hill Farms. It's one of those bottles that you hear about, but most people have never had it. You typically, when you find it behind the counter where somebody is trying to charge you way too much money for it. I paid too much for this, but it was not that much over retail. I've had it for several years. It sat unopened on my shelf. It's one of the coolest looking bottles that you'll see. And it's shaped like a decanter. I mean, I guess technically it is instead of just a regular bottle. It's just all around neat thing. This is a Buffalo Trace product, which is one of the reasons why it's so hard to find because of all the allocations and everything. And it is mash bill 2, we think. They are still very secretive about that, which means it's the higher rye mash bill. It's the same one that Blanton's and all that series comes out of. And it is a 100 proof bourbon with no age statement. It's also a single barrel. So everything that is in that bottle came out of one barrel. They're not mixed together. So each one can be uniquely different, although they're going to have some similar profiles. So that's what we're drinking today.
So very good. We'll certainly get more into our
We'll get
reviews.
Back to this one after we've had a chance to kind of play around with it a little bit.
Yeah, I'll take a few more sips, but we'll definitely give our thoughts on it. But so as most of our topics on this show come from client reviews, client meetings that we have, right? And things that we are talking about actively with the folks that we are meeting with on a regular basis. And I've had, I think, the same conversation 3 times in the last week. So ding,
they
ding,
tend
ding.
to come in groups like that,
right? So ding, ding, ding. This seemed like a pretty opportune time to discuss cash and how appropriate it is, or how much of it you should be holding within a retirement plan or a retirement portfolio.
Okay.
And really, more specifically, redefining the idea of an emergency fund in a retirement plan. Mm-hmm. Because let's harken back and let's go back to the old Dave Ramsey rule, right? And then one of the Dave Ramsey's baby steps is make sure that you save up enough money in an emergency fund, right? 6 months worth of expenses, 6 months worth of living expenses, right, whatever that might be. So if you're spending $3,000 a month, right? $18,000, you know, if you're spending $5,000 a month, $30,000 a month. Yes, I do math.
It is Friday.
So. Yes, I do math for a living, and I've started drinking already.
That's why we use calculators. We don't even try that anymore.
So, but all that to say, 6 months worth of living expenses, pretty self-explanatory. The idea behind an emergency fund, and what would you say the idea behind an emergency fund is?
It's for emergencies. The name kind of throws it out there. bad things happen to good people, and you can't always forecast what they're going to be. You can't always see this thing coming. So the idea is that you have the cash available to you to be able to pay for that emergency without having to go into debt, without having to put it on a credit card or something along those lines, which I think we all agree that is always a bad thing, to go into debt over a very small thing.
Or even more specifically, let me add, because
All right.
this is another reason why you want to have cash available on hand, because you don't want to dip into what? Your
retirement
accounts.
Savings. That's right.
Exactly. Yeah. And so, and Dave Ramsey is certainly wise in this regard. I mean, it's absolutely something essential. You should obviously have cash available for you in the event of some type of unforeseen emergency, especially if you are below 59 and a half years old. You need to have an emergency fund. You need to have cash available because you certainly don't want to be paying 10% penalties to access money in a retirement account. First and foremost, you don't want to pay the 10% penalty, but even above and beyond that, you don't want to interrupt the value of compounding interest, the tax-deferred compounding interest that you get within those retirement accounts, right?
Yep, that's right.
So the whole idea of an emergency fund strictly comes from the idea of when you're younger, you need cash available so you don't dip into your retirement accounts. And, of course, take on debt and all that other stuff, right?
Well, okay, so I'm going to stop for a moment. First of all, you just said kind of a key word, younger, right? Yep. So I know we're going to go down and talk about that a little bit, but I want to define a couple of things first to make sure everybody knows what we mean by this. So two things. First of all, cash. What is cash? To some people, cash is the physical bills in your wallet or stuffed under your mattress or wherever you've got them. Some people would define cash as monies that are in checking or savings accounts, right? Non-investments. Those are both true. Cash in an investment account is still cash. It does not have to be the physical bills. It is a highly liquid. That was graceful there. Yeah. It is a highly liquid item, right? It is basically instant liquidity. That's what we're referring to with cash. The second thing, I'm sure you've done this a lot too. I've had clients come in and say, hey, would you mind just talking to our young adult children, our 20-somethings, early 30-somethings, kind of put them on the path, give them some advice. And one of the things that always comes up is an emergency fund. But I want to define what an emergency is, right? I don't like my car anymore and I want to go buy a new one. That is not an emergency, but I've heard that, and you have too. I can't stand the colors of the walls in my house. They've got to be painted. That is not an emergency. An emergency is something that if you don't change this situation, you or your family are going to be negatively impacted in the immediate future. So you need to be really honest with yourself about what an emergency is.
Yes.
Okay? So, all right, go ahead.
Well, it's also that's a fantastic point because you don't want to view big expenditures that you typically need to save towards as emergencies. Those are not emergencies.
You plan that.
Now, if the dishwasher breaks, that's an emergency. If the tire blows out on your car, that's more of an emergency. Things that need to be fixed immediately and you need access to cash. So that is a fantastic point. But when we talk about younger clients needing access to cash, it's because we're trying to avoid them having to dip into their retirement savings prior to 59 and a half. And this is a conversation I've had, like I said, 3 times in the past week with clients that are at or near retirement age. Okay. Actually, one of them just retired, and she's still holding on to a certain amount of cash in her savings account. Right. It's not doing anything, but she's so used to having that. Let's call it emergency blanket. What do we call it?
The safety net.
The safety, the safety blanket, the safety net. She's so used to having that, that layer of comfort in her bank that she doesn't understand why she would ever get rid of it. And this is some of the things that we've been talking through and helping her to get a little bit more comfortable putting some of that cash to work, at least in something that's going to yield her a higher yield, get her a little bit more income than what she's currently getting in her checking and savings account, which is a big zero, right? So I told this to her, and this is something that we talk about a lot. with clients. And you try to explain to some of these clients that cash is one of the riskiest assets that you own.
I would argue it is the riskiest asset.
And in some regards, that's 100% absolutely true. And you say that to folks, and you just see them taken aback.
Oh yeah,
immediately.
They bristle
immediately, and they can't understand or grasp the idea how cash is risky. But you have to understand the type of risk that we're talking about.
Right. Okay. So cash risk, we're not talking about the fact that somebody could break into your home and steal the cash from under the mattress. That obviously is a risk if you have the physical cash that I referred to. But you're talking about something different.
So we're talking about inflation risk, purchasing power risk. Is cash volatile? 100%. No, it's not volatile. It's not going to rapidly change value day by day like a stock would, like crypto or something else, like something else would. It is a very, very stable value asset class. And at the end of the day, cash is nothing but an asset class. So it's going to hold its value. It's a very stable value, liquid asset class. Right. There's certainly value to having that as a portion of your retirement portfolio. But when we say cash is one of the riskiest assets that you can possibly own, if we sit here and we know that inflation is a fact of life, inflation is going to occur, especially when you look at inflation over the last several years.
Yeah, sure.
But even in the most rosy of inflationary environments, when we're looking at maybe 1 to 2% inflation rates, you're still losing 1 to 2% value of that dollar over the course of a year. So whatever amount of cash that you have today in your bank account, let's say you are sitting on $50,000 in your savings account, that $50,000 1 year from now, yes, you still have $50,000, but it's not worth.
It won't buy what it did a year ago.
Exactly.
Right? Yeah.
It's not worth what it was a year ago. And so when we say it's one of the riskiest asset classes that you can own, we mean that because it is a guaranteed loser in your portfolio. We know for a fact, 100% certainty, that the cash that you own in, whether it's an investment account, whether it's the savings account, checking, it does not matter. That cash will lose value 100%. It will lose value 100% of the time over the course of a year.
Because inflation is natural and it happens every year. And we've talked about it. You just said this a minute ago. The last few years, inflation has been more impactful than what it had been in the previous 10 years because it's been much higher. And we could do a podcast on that concept. But even in those rosy years, you're still losing that value. To my knowledge, without having anything in front of me to look this up, we've had 1 year in the last 50 that was a deflationary year, right? And that is a very bad thing for the economy. But it was 2011, if I remember correctly.
And we don't want deflation to occur.
Deflation
then we have
bad.
A whole host of other issues in the economy.
So inflation is a naturally occurring thing. Quite honestly, as long as it's not too high, you need it. It's normally occurring, and therefore, cash will always lose value, and that's why we say it is the riskiest investment that there is, not because of the concern about theft.
Yeah, and so even after we had these conversations with clients, it still sometimes doesn't always register, but it's 100% true. And over a while, they typically tend to get it. I'm assuming you probably have many of these same conversations on a pretty regular basis. Yeah. So it's just interesting in having to redefine the value of cash or where cash should be placed within your retirement portfolio. Right. Now we're going to go away from younger clients because younger clients need that.
They need to have that. Yeah.
Let's say you're 65, 70 years old. Okay. And you are actively taking distributions from your retirement portfolio, most of the time it's going to be coming from a 401k, an IRA, some type of a qualified investment account that's probably pre-tax. Normally, we're going to take out and we're going to try to withdraw those down as much as we possibly can first, right, to whatever degree that we possibly can. And then you take out distributions from your Roth and your taxable accounts, usually later in life, because those are, from a longer term perspective, far more tax efficient, right? So this is where, so even if we get clients on board with, okay, I probably don't need as much in cash, let's find a cash alternative. And let's just put it in something that's going to get me a higher yield. No. I mean, yes, I understand where you're thinking, but this is where we go to the idea of asset location within a portfolio. Not asset allocation, right? Asset allocation is, having the proper diversification, stocks versus bonds versus alternatives, right? Having that proper portfolio diversification, which is obviously important. But a lot of people don't take the next step and understand the true value of asset location within your portfolio, which is understanding that the most tax efficient assets need to be held in a taxable account or a tax-free account, right?
Right.
And the most tax inefficient asset classes, typically those that are generating ordinary income or short-term capital gains, those need to be held in a tax-deferred account or a tax inefficient account, because those distributions from a tax-deferred account are always going to be treated as ordinary income anyway. So what we want to avoid is trading long-term capital gains for short-term capital gains or for ordinary income, right? We don't want to take an asset that could be taxed at a more favorable tax rate and trade it for something that's far less favorable.
And just to clarify for anybody who does not know, short-term capital gains, meaning you bought and sold whatever it is in less than a year, is the same thing as your ordinary income tax rate, right? It's the long-term capital gains we're talking about. Those are always less than whatever your ordinary income tax rate is.
Yeah. So taking that next step and layering your portfolio with asset location is highly, highly important, because this is where we're trying to add an alpha, right? We talked about advisor alpha. Vanguard did a white paper a number of years ago talking about the value of utilizing an advisor, and this is one of the ways that we truly provide an additional layer of value, because it's not all about just returns in your portfolio. It's also about how those returns are taxed. And if we can make your portfolio far more tax efficient, we might not be getting you extra quote unquote return on your investments, but we're helping you keep more of your money. So your overall rate of return is actually higher because you're keeping more of your money, right? You're paying out less in taxes. So going back to cash, if you have clients, and we have routinely see clients $50,000, $100,000, $200,000. We just brought on a new client and they're sitting on about over $300,000 in cash because they didn't know what to do with it, and they are approaching retirement age. So we need to optimize their portfolio, because if they're going to start taking distributions, they're going to be receiving their distributions from their IRAs, from their tax-qualified, tax-deferred accounts first, usually.
Typically,
and they're going to be paying they're going to be paying ordinary income tax rates on those. So we need to be holding cash or cash-like investments that are generating ordinary income. We need to be holding those within an IRA account, or we need to be holding them from the accounts in which they're going to be receiving their income already. So when I talk to clients about taking their cash and reallocating their portfolio and maybe making their positions in their IRAs a little bit more conservative, and then taking their cash and investing it in equity funds, man, I get some funny reactions on that one sometimes.
So it kind of stopped you for a minute. I'll play a little devil's advocate, because what you're talking about is positioning cash to be part of their overall income strategy, right? And that's where the location is important, to have it in the right accounts. Keep in mind, don't get accounts and investments confused. They are mutually different. They are not the same thing. Your Roth IRA is not worth anything. What you have in it is what's worth something. It's just a set of rules.
It's cookies versus cookie jars.
Exactly right. Okay, so let's play devil's advocate and say, all right, I'm a client of yours, and you sold me on that concept. I like the idea of getting my cash located and everything, but I'm a little worried. What if I suddenly have to get a new roof on my house, or the HVAC dies and it's July here in Kentucky, which we know can be miserably hot, right? Everything in my house was sweating this morning when I got up, and I said, yeah, I know it's going to rain because of the humidity, right? So let's just say one of those things happens to me.
And it does.
Right? And that's what the emergency fund is traditionally for, is to handle those things. I got to do something. How would you deal with that?
To be clear, I'm not necessarily talking about replacing the entirety of your cash. Really, we're talking about excess cash.
Right.
So if you have an excessive amount of cash that you're holding on as kind of a safety blanket, that is actually detrimental to the long-term performance of your portfolio, and we need to make sure we're doing something with that. But to your point, if you need additional funds quickly, it's interesting, because once you become 59 and a half, you don't need an emergency fund for the purposes of avoiding dipping into your retirement accounts, because everything in essence becomes an emergency fund. You have access to your entire portfolio, retirement accounts, cash, taxable accounts, whatever. Everything becomes available to you at 59 and a half, and you don't have to pay that 10% penalty. So this is where, and ideally, we have clients with different types of accounts that we can choose to draw from, whether they're tax-free, tax-deferred, or taxable, right? And so we can create some tax diversification, meaning we can kind of pick and choose how we want them to receive their income based upon the tax liability of the income that they're going to be receiving. Because we don't want to bump them up into new tax brackets or cause, bump them up into like a new IRMA tax bracket on Medicare and having to pay Medicare premiums and things like that, right? But ideally, to your point, everything becomes an emergency fund. Everything is available for you for distribution. So that's where you say, okay, if you need to go replace the deck because it's rotted out, or we had an accident and something happened with the roof, and we need access to quote unquote cash. Right? You still have access to it, but you have access to it throughout your entire portfolio. So then we can go in and we can pick and choose specifically which account is going to be the most tax efficient way for you to receive your funds. Because what we don't want to do is hoard excess cash in our portfolio just so we have a safety net, a safety blanket, just so we can feel good about ourselves, which is important, and money is emotional. And certainly we want to feel good, but we want to make sure that every dollar in your portfolio has a job, right?
No lazy money. That's what I like to say. No lazy money.
And every dollar within your portfolio needs to have a job, and it needs to be doing something, right? And at the very least, if you have too much cash, you have too much cash that is 100% losing money. We know that it's a guaranteed loser over the course of a year, not to mention 10, 15, 20 years, right? So we need to make sure that we're putting that money to work as best as we possibly can. I'm not saying taking excess risk.
Of course not.
I'm not necessarily saying let's take all your cash and let's throw it into Bitcoin. That's not what I'm saying, right?
We had that conversation with somebody earlier this week too.
Yeah, but I am saying you still want to maintain an appropriate amount of risk throughout the portfolio from the top down, right? When we're looking at the overall portfolio, we don't want to take any excessive market risk or excessive volatility risk, but we do need to try to reduce inflation and purchasing power risk as much as we possibly can.
So what can a client do? They still need to have access for emotional reasons, for argument's sake. They need to have access to cash for that emergency. What are some things that they can put that into that would keep pace with inflation, for example?
Well, the easy answer is high yield savings accounts, of course. So most people think about their savings accounts at the bank, and if they're yielding 2%, that's pretty good.
You got a pretty good one if you're getting 2%.
So, you can usually get access to online high yield savings accounts that are typically going to generate maybe 3.5% to 4%. There's some fixed income.
I just looked at one yesterday. It was at 3.8. So you're right in that.
Yep. So you can use U.S. Treasuries or short-term U.S. Treasuries that have very low risk, that are going to pay a little bit higher rates of interest than you would typically get on a savings account or a high-yield savings account. So there's layers of risk. Risk is always on a spectrum, right? So you can go from a zero on let's say I'm from 0 to 10, right? On a scale of risk. You can go from a 0 to a 2. You're really not adding much quote-unquote risk. You're actually de-risking a certain part of your portfolio. Maybe you're taking on a different type of risk. But there's all kinds of different fixed income instruments or very ultra short-term fixed income instruments that you can utilize that are going to generate higher rates of return or higher yield, I should say, than cash in a savings account.
So the question that people are going to ask, okay, so if I'm going to use some of those, so a high-yield savings account, just if you've never seen one, they're typically done with online banks. And they can afford to pay out a little bit more than what your traditional bank is because they don't have the brick and mortar. They don't have the employees who are sitting there waiting for you to walk up to the teller. And those are expenses. I mean, most banks are kind of nice when you walk in. Well, there's a cost that goes associated with that, and that's why you're losing that yield. When you talked about U.S. Treasuries, for example, arguably the safest investment that there is, right? We could have a whole different show on the why that is the case or not the case. But to your point, treasuries are actually a good option because they are liquid. They are easily sold. You can turn them into the cash and then generate what you need very, very rapidly. And the last one I looked at, which was earlier this week, you're typically in the low 4% range. So you're staying ahead of where current inflation is. Not by much. It's not a sexy investment by any stretch, but your money's not sitting there getting a half or 1% in a savings account. And you can get to it very, very rapidly.
But I would also take one extra step and go back to the idea of asset location,
Mm-hmm.
right? So if you
Where
take
do you put that?
so everything that we just talked about, what type of account should you hold that investment in?
Right.
What cookie jar should you put that cookie into, right? Mm-hmm. Typically speaking, all of these investments that we're talking about generate ordinary income. So you're going to have to pay taxes on that ordinary income. The best place to locate those types of assets is typically going to be in an IRA. So if you've already got an IRA account, you want to reposition your portfolio to take these tax inefficient asset classes that are going to generate ordinary income as they are, right? You want to place them in an IRA so you can defer having to pay taxes on any income that comes in from those types of investments. Because we know that the income from those investments are going to generate ordinary income anyway.
Mm-hmm.
That way we can at least defer them until we have to realize that as income. Especially if we're already taking distributions from an IRA account in retirement as income to supplement your income needs in addition to Social Security and pensions and things like that, right?
Right.
It's just a far more efficient way to locate correctly the right asset classes where they're going to be the most efficient in your portfolio from a tax perspective.
All right. So let me try to kind of change thoughts for a second. Is there any time in which you could use debt as your cash position?
Sure.
Okay. How would we go about doing that?
Well, it will define. There's all kinds of different ways.
And I've got one specific in mind. This is not for everybody, but it's one that can work.
Well, there's all kinds of different ways to do that. So as long as you're responsible,
right?
I mean, if you need access to cash or if you need access to money, I should say immediately, throw it on a credit card and make sure you get your credit cards paid off every month.
But pay it off at the end of the month, right?
But at least what that does is, okay, if I need something today, I need money today, you put it on a credit card, and then that gives you 30, 45 days to figure out to raise, right? If you need to sell investments, you can raise cash from some of your investments elsewhere. It gives you time to take care of all the other logistical stuff.
That's one of the biggest ones I've had clients say over the years. They say, well, you know what? I need to have this cash available to me in case. And the one that always comes up is, what if the furnace dies? What if the air conditioning goes out? And if you've ever experienced the air conditioning going out in your house in July or August, and I have, right? Sure. The last time it happened to me was in August. And my parents at the time were like, well, do what we used to do. We just opened up all the windows. Okay, well, modern houses are not built to ventilate the same way. So especially if you've got young kids, right, which I did the last time that happened. I need the cash so that I can buy the new air conditioning or pay for the repairs. Okay, so go back to what you were just talking about with the credit card. I have never experienced any situation where the person that I'm going to do business with as far as doing a repair or replacing equipment in my house needs me to pay cash today, right? First of all, it's probably going to be a week or two before they can get to you in the first place.
Correct.
Let's just be real honest here, okay? You might need a little cash to go up to Walmart and buy an air conditioning, window unit or something. So you can put those kind of things on a credit card and then make the securities transactions from your IRA or whatever account in order to create the cash and pay the credit card off. That's where people just, for some reason, they don't seem to understand that concept of you can use debt on a very, very short period of time, especially if you're talking about a credit card where you're going to pay it off within 30 days. There's not going to be any interest on that. If you have a credit card that would charge you interest inside of the first 30 days, you need to go get a different credit card because that thing's horrible. That's what I mean by using debt, but we're still not going to be racking up any interest on it if we're responsible with our money.
And I'll even go a step further and say a lot of this is generational, right? So we're talking about clients that are at or near retirement age. So let's say we're talking, 65, 70 years old, give or take, maybe a little bit younger, maybe a little bit older. But we're talking about that generation. their parents come from the generation of the Great Depression.
Right.
So their parents were born in the Great Depression, and they probably grew up looking at credit card debt, having to pay interest on credit cards, and credit cards are evil, and never use a credit card. And there's certainly, validity to not having to pay interest on credit cards, but they also grew up with the mentality that cash is king.
Right.
Because they probably learned that from their parents.
Who had to go through the Depression, right?
Exactly.
Where, banks were failing and all those things. So there is an emotional part to this because of the way that we grew up.
Exactly. And so it's very, very important to understand and recognize that yes, I'm not necessarily downplaying cash as a whole. Cash is an important asset class. You need exposure to cash, 100%. But what we're talking about is excess cash. Having too much cash in a liquid position hurts you in the long run. And if you are retiring at 65, the average retirement is almost 20 years long. The average life expectancy is about 81, 82 years old. Well, the average life expectancy, if you're a married couple and both spouses live to the age of 65, there's a 50% chance that one of you is going to live to 94.
94, that's right.
There's a 25% chance that one of you is going to live to the age of 98, because the longer you live, the longer you're going to live.
Right.
The average life expectancy for someone at 65 is higher than someone at 1 year old.
And the reason for that, people don't understand that. I hear that all the time, especially when we start talking about claiming Social Security and things like that. When we talk about life expectancies, keep in mind that the average life expectancy of a man and the average life expectancy of a woman, when they just throw that number out, that's got infant mortality. That's got people who die in car accidents in their 20s. That's got people who contract cancer and die very young. All those things are in that statistic. And that's why what you just said was spot on. The longer you live, the longer you are going to live, because statistically, you've beaten some of those odds back already.
Yep.
And that's where cash can get you in trouble. I brought on a client earlier this year. They were literally sitting on over $500,000 in cash. And the reason for that is she was afraid of loss, right? It goes back to what we were talking about. You are losing, right? Because the buying power of that cash is changing. You don't have to go out and take your cash and put it into something risky. That would probably be inappropriate to put it all into something risky, but some of it needs to be positioned so that you can use it in your late 80s or early 90s. What happens if you live that long and you've been sitting on cash it just doesn't have the buying power that it used to? You love to use the phrase, the power of 72, right? So that means that it's something at 10% growth is going to double in 7.2 years. You can apply that into inflation too, which is the enemy of cash, as we discussed. If you've got cash and, in your 60s, it's worth, say, $100,000. What is that worth in your mid-80s, right? It's worth about half. So it's almost like you gave half of your money away over that 20, 25 years because the buying power is just not there. It's just incredibly dangerous to leave it heavy amounts of cash like that.
I saw a stat recently that talked about 250,000 is the new 100,000. Everyone, and even when I was growing up, he said, "Oh, you make six figures. That's kind of a goal to aspire to.
Right.
I want to make six figures." That seemed like such a high number to aspire to. 100,000 is, not to say that it's not valid. Obviously,
sure.
It's important. It's a lot of money for sure. But there's a stat now that 250 is the new 100,000. It basically, the standard of living, the cost of living has gone up so much over the last 20, 30 years that what used to be, a six-figure income, $100,000 in the 80s, you need basically $250,000 to get that same type of lifestyle that you were able to get in the 80s at $100,000.
That's basic inflation. Think about this. And we love to use this when we're talking to, pre-retirees, retirees in workshops. To help them understand the power of inflation, not over a short period of time like we've had over the last, say, 5 years, but over decades or even generations. We'll ask the question, how many of you own a car that when it sold new, sold for more money than you paid for your first house, right? And most people who are over 60 will raise their hands. Yeah, my car sold new. I didn't buy it new or whatever. It sold new for $50,000, $60,000. All the big full-size trucks that you see driving around town all over the place now, right? They look fantastic. That's a $60,000, $70,000 vehicle. My parents' house that I grew up in, when they bought it in 75, 76, it was $43,000, right? A fraction of what a full-size truck goes for now. We sold that house for them 5 years ago, and we sold it for 350 grand. That's the problem with cash. It's not keeping up with that inflation because the cost of living goes up. It's natural, and that's why it's just dangerous to keep all that cash around.
Yep. So that's probably pretty good.
Let's
spot
talk
to
bourbon.
wrap up our discussion.
Let's talk
around
bourbon for a
cash
minute.
and
All right.
let's talk about ways to use our cash and this to go buy a delicious bourbon.
So, what do you think about Rock Hill Farms? I know what I think.
It's good. It's very good. It's smooth. 100 proof.
This is 100 proof.
Yeah.
This is, folks. This is the same juice that they make Blanton's out of. Yeah, it might be in a different part of the warehouse, and that's the whole idea of the sweet spot gets different flavors. That's all true. But I will tell you that this is more of a competitor for, if you've ever had it, Blanton's Gold. The big complaint about Blanton's, for those of us who are snobs about this stuff, is that Blanton's needs to be a higher proof.
And to be clear, if you're complaining about Blanton's, you are a snob.
I am a snob, I admit it. Okay. So if you've ever had Blanton's and you've said, this is really good, but it needs something. What it probably needs is a little bit more proof. So Blanton's is 93 proof. This is 100. So it's kind of the same thing, maybe a different location in the warehouse, proofed up a little bit. Now, if you've ever had Blanton's Gold, and I'm suddenly having an idea for maybe we need to have some Blanton's Gold on the show.
I've had Blanton's, not Gold.
Well, then we're going to have to make that arrangement. So Blanton's Gold is 107 proof, right? So it is Blanton's proofed up. That's what it is. And there's a lot of flavors that come through that don't in regular Blanton's. And I think you get a lot of that with the Rock Hill Farms.
I was getting ready to say when I put a few drops of water in here, it cut the taste. I wouldn't have done that.
Yes, I agree. I tried the same thing. I just put two little drops in, and it did change it a little bit, but not in a way that I liked. I liked it better when it was just neat.
Not dramatically, but it was better neat.
And surprisingly enough, because this is their high rye mash bill, normally when you get to a higher rye, you get more spicy notes. This is not super spicy. It's got a little bit of twang in there. There's a little baking spice flavor, and I'm going to snob out for a minute. I can actually taste some cotton candy, and I can, right? And there's some chemistry that goes into that conversation, but there are some really, really delightful flavors that go into that, but it is not overwhelming. The higher proof stuff, you can argue it's got more flavor to it. Yeah, but it feels like getting hit in the mouth with a sledgehammer sometimes too. This doesn't have that. This is pleasant. It's very, very drinkable as it is. Quite frankly, the presentation of the bottle is gorgeous, right? I mean, there's so many things that you could do with that bottle. This is, other than the fact that it does look a little bit like apple juice, that was the comment that was made before we got started. This is an all-around fantastic bourbon if you can get it at a good price, which is tricky.
If you can find it.
For those people that are watching or listening, there are stores right here in Louisville, and this is true in most of the country. You can find it. I could go buy this within 15 minutes of where we're sitting. I could go to probably 5 different places where I can get it. But it's behind the counter. And there is a price point on there that if you are willing to pay that, my mom used to say, a fool and his money soon part. Well, you would qualify by my definition. Because it can't. I've seen this stuff for hundreds of dollars. It's not worth hundreds of dollars.
Yeah, no.
I think the retail on it is $70, $75 or something like that. This is a fantastic bourbon at that price, but not at the prices that you might see it out there. So if you see it on a shelf at a big box, snatch that up.
I like it.
Yeah,
it's a good pour.
I'm
a fan.
Makes for a good weekend. So I don't think we need to go too much back into cash. We've kind of beat on that. If you are holding a lot of cash, there are better things that you can do. Your money is being lazy. Money needs to be assigned a job, and it needs to go out and work for you, not just sit there building a nice building on the corner, which is what unfortunately it's doing in a more traditional bank. Lots of options. We discussed them. If you got any questions, reach out to us. We'll be happy to give you more detail. So we'll wrap up on that. We'll wrap up on a very, very good pour of bourbon. And thank you to the families of all those people that paid an incredible price on this day. 81 years ago today?
Give or take, yeah.
Well, not give or take. We get to
Was
that.
it I don't remember the
Let's see. It's 2025. That was 1944. Yeah, 81 years.
Okay.
Okay. All right.
Salute. Until next time.